Hi everybody, and welcome to today's edition of the 7 Investing podcast. I'm Luke Hallard, lead advisor at 7 Investing, where it's our mission to empower you to invest in your future. I'm joined on the podcast this week by Adam Mead. Adam's the CEO and Chief Investment Officer for Mead Capital Management, and he's also the author of The Complete Financial History of Berkshire Hathaway, an extremely well-reviewed chronological history of Berkshire from its inception as a textile conglomerate in the 1950s to its status today as one of the world's largest companies. Adam, welcome to 7 Investing.
Thanks, Luke. It's great to be here.
So just to frame up our discussion today, I'll give a little background on myself. I guess I will say I was a Berkshire shareholder from 2008 to 2019, although I can primarily consider myself to be a growth investor. And I think our listeners will tend to be more growth-oriented too. Probably also fans of the disruptive innovation strategy, perhaps best exemplified by Cathie Wood's Ark Invest fund. Well, the last 8 months have been pretty tough time for growth investors, me included, and Ark themselves are currently underperforming Berkshire by pretty much any time frame you look at. So it got me thinking that a conversation with an expert on Warren Buffett and Berkshire Hathaway might be a great opportunity to remind us all of some of the timeless wisdom demonstrated by Berkshire, maybe how these could translate into lessons for growth investors. That's what today's conversation is all about.
I think there's a lot of lessons here, and value investors tend to, especially the Berkshire followers, tend to kind of poo-poo Cathie Wood and Ark, but there's some lessons there. I think it really, in my mind, is kind of a matter of almost time period and patience and all that. But We'll dig into some of those. I think there's a lot more commonalities there than most people realize.
Oh, I really agree. And you've been kind enough to dig out 5 key lessons, but I'm sure that could easily have been 50 or 500 if you were to really, if we had a really long recording. I guess you and I connected as a result of the conversation you had a year ago with the Investor Way UK podcast. And I thought that was a really fascinating discussion on the history of Berkshire. And also I gather how your book was informed by a conversation you had with Warren Buffett himself. Is that right?
Not a conversation. It was actually, I have met him. I've shaken his hand at one of the annual meetings. But my book was largely done with existing sources. I really, to use an old phrase, stood on the shoulders of giants with all this information out there. I had a little bit of communication via email through his assistant, Debbie. And, to my surprise, when I first broached the subject of writing the book and gave him the first couple of chapters, he was enthusiastic and encouraged me to go back. So that's why, of course, Warren Buffett suggesting something, right? I'm going to do it. That's how I ended up going all the way back to literally the beginning of the textile industry, and it's a fascinating story, a growth story, in fact.
Yeah, I guess so. We're definitely going to pull out some parallels between distinct things of value investing and growth investing. But perhaps, as you say, they're actually, much closer than maybe those words portray.
For sure.
In compiling the book, I gather you went through over 10,000 pages of annual reports, transcripts, of course, Warren's famous investor letters and commentary, and you've built out that, fantastic reference guide. Do you think in doing that, you've changed as an investor yourself?
Oh, for sure. Without a doubt. And in fact, it might seem kind of funny to hear, but I actually learned from my own writing when I was going through and doing some of the final editing, because, it took 5 years to write this book and digest all this material. And this was even after, sort of 15 years of studying Warren. So, I even learned, when I got through, because I had gone chronologically, and then when I got through and kind of read it all, I even came up with, some insights just from reading my own writing. So it definitely was an exercise worthwhile in its own right, and I've been pleased by the reception of the book, and it's just been great.
Fantastic. Well, we'll drop a link to the book for listeners into the show notes, so you can go find a copy. I'm sure it's available at Amazon and all reputable booksellers.
It is, although I should say, it's the title is The Complete Financial History, and I it's now the incomplete financial history because we're, a couple of years removed, but I guess I'm due for an update in a few years.
Very good. Well, and one other thing I might say, just in intro as well. So I had a bit of a trawl through your LinkedIn profile. I noted a quote or a comment from you that really resonated with me. And you said, underlying everything is my constant search for timeless wisdom through a rational study of our interconnected world. That feels quite close to my own investment style as well. Could you bring that to life a little bit?
My own background, I come from a family of business owners, and I spent 10 years in banking, and I never had that, okay, I'm going to, own a restaurant, or I'm going to, become a plumber. Like I've always was just so curious about everything. And so I think that's what led me to banking, where you get to see a ton of different businesses, and then ultimately to investing. But it goes beyond that, and this interconnectedness of the world. Charlie Munger, who is Warren Buffett's business partner, longtime business partner, is very much a polymath along the lines of Benjamin Franklin and Leonardo da Vinci and some of these guys that just bring everything about the world together to help with what they're doing at the time, and it's clearly worked very well. And Charlie is a multi-billionaire in his own right, and he has influenced Berkshire Hathaway, for example, by looking at business systems as ecosystems, and parallels between ecology and biology and physics, bringing that to the investing forefront. And it just completely resonates with the way I think. And I'm just curious again about everything. And I mean, even things down to poetry and art, even though I don't quite appreciate them as much, I think can in some ways make you a better investor.
Fantastic. I completely agree. I'm learning to play the piano right now because I consider myself to be too much of a scientist and not enough art in my life either. Not sure how I'm going to tie that into investing, but maybe there's a lesson there at the end for me.
Oh, that's great. No, I mean resonance, right, and finding the right tune, and I mean just all that stuff. Yeah, that's great.
So I suppose when we think about Warren and Charlie, two of the world's greatest investors, and as an expert really on Berkshire and also their own investing decisions, so you've been kind enough to pull out 5 investing lessons that we'll go through today, and then we'll have a bit of a chat about each one, see how we can relate that to growth investing. Do you want to kick us off with those though? What would be the first lesson for a listener?
For me, and having the growth, your audience and the growth interest and mindset, a lot of times the complexity can make it seem exciting. And I guess the first lesson would be business need not be complicated to be exciting. You can still have that excitement. And ultimately, I mean, what are we ultimately trying to do as investors? We're trying to grow our capital. And so a dollar earned by investing in, a boring, say, waste management business, a garbage pickup business, this is the same dollar that's earned in some flashy high-tech business, right? I mean, ultimately, that's what we're trying to do. And so I think when it comes down to it, you don't have to understand every single business that's out there. You don't have to understand, every industry. Really, pretty few will suffice. And if you look at your own, no matter what you do, I mean, you might be a doctor. Okay, well, what kind of products do you use? Or a scientist, or you might work in an office, and just you may come across things that you have a better understanding of because you're in that industry. I mean, one example would be just a product. I just in talking to business owners in my time in banking, it's like, oh, geez, this supplier keeps raising this price, and I can't switch. And it's like, ding, 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 something goes off in my head. Okay, that might be a good business because you can't drop it. But if you're not in that business, you wouldn't know that. And so I think it's really up to the individual investor to sort of calibrate the businesses that they look at. If something's exciting and it's flashy and it's going viral on Twitter or some other platform, you don't have to jump in. I mean, you might want to learn something from it. Again, there's that continual learning. What can I learn from this? But you don't have to understand every business. And just as an example with Berkshire, the last tech boom, around the 2000s, everybody was excited about high technology. Well, what did Berkshire do? They went the opposite direction. They bought all these, quote unquote, boring businesses. They bought Benjamin Moore for $1 billion. They bought a furniture manufacturer. They bought an insulation manufacturer, a brick maker, a carpet manufacturer. I mean, all these just very simple businesses that you can understand, but they made cash. And that was, I guess, sort of related. Just that's another lesson. Just they have to make cash. And Warren has this wonderful quote. It's better to step over 1 foot hurdles than jump over 7-footers, right? Investing is sort of counterintuitive in that every other walk of life, more effort equals more achievement. You have that sort of one-to-one linear relationship, and it's just not the case in investing. And in fact, I find, as I've now been an investor for over 20 years personally, the more I know, the smaller my circle of competence, which is the area that I think I understand, actually shrinks. I think I've just become better at defining it. And so I think to the extent that you can do that, it can definitely make you a better investor. And the fact that, especially with the growth arena, I mean, all you need is one 100-bagger or a couple of 10-baggers to really secure a pretty meaningful life for yourself. And I think if you just kind of step back and remember that, it takes a little bit of the pressure off to be so active. So I think there are parallels there between the stodgy value investing way and the growth investors.
That's great. And there's so many fantastic things to unpack there. But maybe if I try to pull out sort of two things, particularly it resonated with me. I've been quoted as saying before, 99.9% of the time, the right thing to do as an investor is like nothing. You don't want to be messing around with your portfolio. Keep it real simple. Buy a good quality business in a growing domain, and then just kind of stand back. And I also like your point that sort of growth or capital appreciation can be found anywhere. And you don't have to be even a doctor or a professional. You could just be looking at your own hobbies, and maybe you like playing video games or something. And you're getting almost all of that fantastic research you're getting for free just through your own passions and occupation and the way you spend your time. So that's a great sort of aligning your own interests with your investing domains.
Yeah, and if I could just add to that, Luke, I think you will do better researching and following something that excites you than something that doesn't. There are industries that, for whatever reason, I just haven't. They're good. They just don't really excite me, and you just can't really force that. I think if you have that natural passion, whatever it is, if you can lean into that, eventually you'll find something in the investing world that you'll be able to do that makes you money.
I will say one of my co-lead advisors at Seven Investing, Matt Cochran, he's a big fan of what he self admits as being boring businesses. He's got some of the best returns on our scorecard. Well, one company he's a huge fan of is Domino's Pizza. It doesn't get much simpler than that, making pizzas. But it's a fantastic business that's generating fantastic returns for its shareholders.
Exactly, yeah. And Berkshire is just full of these quote unquote boring businesses. Like I said, all these building products businesses and candy companies and glove manufacturer. I mean, just it's like it's almost where's, and Warren even talks about this. Everybody looks for this secret, and here it's just all out in the open, and it's really just staying out of your own way a lot of times.
Yeah. Very good. Well, a great lesson there. Should we go on and look at our second lesson for today's podcast?
Yeah. So the second lesson that I think is worth highlighting is follow the business results and not the stock price, and that it's so fundamental, but it really is worth remembering. And the price action is just daily and constant, and it's business just doesn't change as quickly as people's opinions. And I guess the way I kind of think about this, Luke, is you have the chicken and egg problem. Well, what came first, the business or the stock? Well, clearly the business came first, so let's focus on the business first. You have to know what you own. I mean, it would just be kind of crazy for someone to come up, think of wherever you live, in your town or city, and someone says, well, geez, I'll sell you, 2% of this business, do you want in? You have an hour to decide or something, and you'd say, well, no, this is crazy. I need to know more. I mean, but people do this with the stock market. It's so quick to act. It's almost, there's two sides to what I'm going to say next. The more effort that you put into understanding a business and studying it, the more conviction that you're going to have to hold on when times get tough. It's sort of, the level of your investment up front is kind of the stickiness with how much you'll stick around if things go the other way. Now there's the risk of, consistency and commitment bias, where you've put all this work into something and then it's ultimately not the right choice. And you say, well, geez, I just spent, 2 weeks really digging into this thing. I have to buy it. There are ways around that. You could buy one share and just kind of follow it. I mean, there's things that you can do. But I think, again, just to kind of highlight what we just talked about, investing in what doing your own due diligence. There's so much information out there. I mean, we're so lucky today. I mean, you can just pull up, just a quick little Google search and you find interviews with people or call. I mean, pick up the phone and call investor relations. I mean, that's one thing I'm just surprised more investors don't do. Know what you're assuming, I guess. When you're buying at a certain price per share, that implies a certain market cap, a price for this whole business. Would you buy this whole business? And when you make that purchase decision, you're locking in your future return. And so you, as an owner, are ultimately only going to get what the business earns. Now, there are a few ways that may change. The underlying business results may get better. They may improve margins or something. Or you might sell at a higher price to earnings ratio. But it's much, even if you are, you consider yourself a diehard growth investor, you would be better off focusing on the business results and not count on selling it at a higher price. Well, geez, I'm going to buy this because people are going to get excited about it, and the price earnings ratio is going to go from 30 to 50. I'd rather take the bet that, well, they're going to do this risky project and it might pay off. That's the better bet to make, even though it's riskier.
One crucial thing in where you're sort of comparing those two things is something like valuation multiples, what the market is willing to pay as a price to sales or a price to earnings ratio. They fluctuate, in cycles, and we're in risk off mode now. So people are paying much lower multiples, but they tend to fluctuate within a range. And, as we go from risk off back to risk on in the next couple of years, and then we'll cycle back into risk off, that's going to move around. But the thing that isn't dependent on that cyclical nature is the fundamentals, as you say, the actual earnings, the revenue the company is generating, or how efficient it is with the money. So if a company can, that's very simplistically, double its revenues, well, when high price to sales multiples come back into fashion, as they will at some point, those real fundamentals are going to be realized.
That's right. And the power of knowing your business, especially with growth businesses where they might not be showing a lot of earnings, right? I mean, the price to earnings ratio might double for the simple fact that the business invested in some growth and earnings were cut in half temporarily. So, you really, it just always comes down to knowing the fundamentals. And that's, sort of a little sub lesson from Buffett, which is he has, when you study Berkshire Hathaway for any period of time, he only cares about economic earnings. The accounting is just a starting point. It's important. It's the language of business, but you really have to know what are the underlying economic earnings of the business. And again, if you've done your homework and and you listen, one example comes to mind. I own a company called Simpress. I've owned it since 2014. Simpress is the holding company for Vistaprint. They make business cards and they do business marketing and so forth. This mass customization business, growth business, I guess I would say. It's so fascinating to me. There's been a couple times in Simpress's history where they will actually they will say in either an earnings call or generally in sort of a strategy document, we are going to do X and it's going to hurt earnings. They do X, it hurts earnings, and the stock goes down. It's like, well, I mean, it's almost like who is paying attention to this? So I think again, just if you have conviction on a business and you go deep on it and you listen to management, those are all those qualitative things that you can really give yourself a leg up, because from my observation, and I'm probably not qualified to say this, but it seems to me that the sort of everyday growth investor, the sort of flashy growth investors, they're just sort of ephemeral, right? They just come and go. It's exciting. Okay, this is boring. I'm going to move on to the next thing. But you can still be a growth investor and go deep and share that same fundamental analysis passion that value investors do.
Yeah, absolutely. And, you know, we've even within Seven Investing, we've fostered a community of 1,000 members now. We're all having active debates, and our subscribers are adding as much value as the lead advisor team in terms of, you know, understanding an industry, understanding what's happening with a company. It's fantastic to have the opportunity to sort of debate companies that you love with other folk who are really interested in them, but also maybe to get the bear case as well. That's going to be really helpful to inform your sort of thesis and your investing decisions.
Oh, for sure. I mean, one of the things I almost always do is search. You know, when I'm interested in something, search. You know, short thesis on X.
Yeah.
You know, if someone's betting their own money against something, they're probably going to do their research. So that's a great reminder there.
And maybe just take us back to the first thing you said when we started talking about this one, because I think it's a fantastic point. When times are volatile and maybe your stock price, maybe you think it doesn't reflect the true value of the company, well, rather than panicking and letting your emotions take charge, that's an opportunity just to go and revalidate your due diligence. Go read the latest 10K, 10Q. Go, you know, look at maybe a podcast with the CEO. Try and remind yourself why you're an owner of that company. And often that's going to help you sort of stay the course and stick to that long-term investing mission.
Yeah, and you should, you know, just sort of as an aside, you know, write down why you're buying something, you know, and it should only be a couple sentences or a paragraph, and then go back and look. I think when the market goes down like that, it's always an opportunity to say, hey, the market may actually be smarter than me right now. What am I missing? Now, if nothing has changed, there's no information that's changed to update your thesis. Okay, now I'll hold or buy more. But you can have that humility to just kind of pause and say, what am I missing?
Very good. Great. Well, we're through 2 of our 5 Buffett lessons. What's the third?
So number 3, the power of investing in niches. And so this is kind of counterintuitive. And again, this may be a bias on my part, but oftentimes a niche which appears to be no growth can actually be more protective of economic earnings than growth. So Berkshire owns a business called Lubrizol. It's an oil additives business. It's a pretty limited market, you know, maybe, I don't know, $25 billion a year, something thereabouts. It's not a huge growth business, but it has fantastic economics. Another one is this business called Kansas Bankers Surety, which insures bankers, and they have relationships with bankers all across the country. There, I think you have a couple things going for you. One is just that power, that protective niche, which again, you see in ecology. You have protective niches that species survive where you wouldn't otherwise think they would because they're protected in some way. Growth, it can be exciting, but it can also attract, and usually does attract, competition. And so you have that neutralizing factor there. And so bigger doesn't always mean better. It has to come with cash, and it has to come with returns on capital, right? You have to earn a return on capital. You know, a business that's growing 10% a year, but it has a 10% cost of capital, it's not really adding any value today. And really, again, what are we looking to do? We're looking to grow purchasing power, real purchasing power over time. But niches, especially, you know, in technology and other areas, it may, and I don't do this, but you know, for your listeners, maybe there are areas just adjacent to sort of the main thesis, right? Like, I mean, one thing that comes to mind is with electric vehicles and lithium, right? It's like, okay, everybody's focused on the cars. Well, geez, lithium might be the way to go. Or maybe there's a sub-industry that's even more boring and, you know, but still growth, and it's going to be pulled along by the main provider. But one other example, I guess, that comes to mind here is Zoom in the pandemic. Everybody was, that stock just took off, and it was like, okay, geez, they've growth, and they're gonna, people are gonna stick around. That was kind of the basic thesis. Well, I looked at this and I said, this is nuts. Google basically has the same product, and they're offering it for free. Why would you go up against that? It might be exciting for the people that are involved in it. It might actually be very good from a societal standpoint, but it may not be good as an investment.
I will say I've ridden Zoom all the way up. I bought in pre-pandemic when I saw what was happening. I've ridden it all the way down again. It's maybe taking us back to that Ark comment at the start. I don't know if you've done your Zoom homework. They recently published their own research, but also their detailed financial model for Zoom. I think they're wildly optimistic, but they're forecasting a 76% CAGR through to 2025.
Wow.
Now I'm bullish on Zoom, albeit noting exactly what you said. Zoom is effectively, you've got a company that's kind of a feature of another company's product, right? I'm bullish on Zoom, notwithstanding that. But 76% CAGR, there's optimism, and then there's wild optimism, perhaps.
Yeah, and I could learn something from you, I'm sure. But and it may be a bias of my approach. I look at it, I say, okay, this is too hard to understand. I'm moving on. And so that was basically the extent of my analysis. I guarantee you have a far better understanding of the business and where it's different from Google than I do. And that, it doesn't mean that, I'm right and you're wrong. I very well could be wrong. It's just not my thing. And that's, we can still be friends. It's not always like, it's just, again, it's like Ark versus Berkshire Hathaway. And it's like, death, duel to the death. And it's like, I guess there's a place for both, but as long as you understand what you're doing and you don't, risk your whole life savings on it or something.
Exactly right. And that's the perfect filter, right? If it's just too complex for me, well, you probably don't want to go any further, because there are 100 equally good or better investments in domains that you probably will be able to get your head around much more easily.
For sure.
Well, we're getting on to lesson number 4. What's that?
So number 4, the power of patience. And I think here there's a lot of parallels between what Berkshire does and growth investing. Buffett just has this remarkable capacity for patience, and I've gotten better at it myself over the years. Every cycle I'm a little bit more patient. I can wait a little bit longer before, oh my gosh, I just have to buy something here. Berkshire Hathaway, in multiple periods of its history, but more recently, it had $150 billion of cash sitting on the books, and everybody was saying, okay, Warren's washed up. What is he doing? Should have bought something during the pandemic, but didn't. Literally, I think it was February 25th, he published the annual letter to Berkshire shareholders saying, we have nothing to do with our cash. Literally the next day, opportunities start arising. They buy Allegheny, another sort of mini conglomerate insurer, for $12 billion. They buy 10% of Activision Blizzard as an arbitrage play. Ton of money into Occidental Petroleum and Chevron stock, going against the grain of ESG and all of this. Opportunities come infrequently, generally, right? If it's a competitive world out there, especially in the growth space, but if you can just be patient, opportunities generally come your way. And I always have to remind myself, 15% return might not be too exciting for your audience, but that excites me. It's a double every 5 years. But if it takes me 2 years to wait to find a company, and then it doubles over 3 years, or it takes me 3 years to find it and wait, and then it doubles over 2 years, that's still a double in 5 years. That's 15% a year. That will compound your capital pretty quickly. But when you're in it, it's very difficult, very difficult. The other one here, I think, which is really apt to your audience, which, Apple, I think of Berkshire Hathaway's investment in Apple. When a company has an exponential growth curve, you can afford to wait and watch and confirm your thesis and see if this company's going to take off and still do very well, right? Berkshire Hathaway turned $35 billion into over $150 billion. by by waiting. And when he bought in, it was like, well, geez, Buffett's late to the party, all of this, and they've done so well after the fact. So I think that may be the meeting point, if you will, for, call it, Ark investors and Berkshire Hathaway investors. It's like Ark is at the forefront. It's exciting. You're trying to find these things, quickly, early, get in on ground zero. Buffett's okay, waiting until, floor 25 if he thinks it's going to be, the next skyscraper kind of thing, if that analogy makes any sense. But it just all comes down to kind of where you come in at that point. And, Berkshire, again, if it's of any interest to your listeners, they spent, it was like 13 years in one of their insurance companies. The market for insurance just wasn't, it didn't make any sense to write premiums. Risk wasn't priced appropriately. 13 continual years of declining premiums. Now, that's a business that you could afford to wait. They were still profitable, but you don't have to, I guess, you don't have to wait. That's just an example of Buffett's extreme patience, and you don't have to wait a decade, I guess. But even waiting a year, or just being patient, building a watch list, understanding the businesses, you don't have to find the business and it be a right investment candidate all at the same time, right? I mean, you can build that watch list and then be patient and have that active part of what you're doing be studying the businesses, not trading.
Yeah, absolutely. And I suppose it's easy to think, oh, if I'm not invested, I'm not doing something useful. But absolutely, right? You're building your investment case. So you're using that time valuably, and that's going to pay you off in the long run. I guess as an individual investor, there's probably two emotions that, or sort of traps you could fall into here. Kind of one is FOMO, fear of missing out. Oh, I must invest now. I found this, I found the next golden goose. But the other one might be, I've left it too late. Maybe like Berkshire, I've come along to Apple. Well, the growth's already there. Can it keep growing? Well, I think Apple have proven that, winners keep winning. And if you find a robust company with great future prospects, it's almost never too late. Great companies are expensive, and they're always expensive throughout their life cycle.
Yeah, and it comes down to your assumptions. And, for me, I look for quality businesses. And again, that's the whole thesis of watch list investing, is just build this watch list, find the good companies, regardless of how they're valued. But I guess for me personally, I feel much better with a business. I might be wrong, but it's not going to be, my penalty might be a lower compounding rate compared to a business that, is losing money, or all of a sudden something comes in and just totally fundamentally changes the business. Now, that will happen over time, and I've made plenty of mistakes, and I'll make more in the future. But I think having those winners and just being patient is a huge lesson that comes from Warren Buffett and Berkshire Hathaway.
Well, let's take us on to our fifth and final lesson then. What else does Warren have to teach us?
Yeah, so I guess, and again, I struggle to keep it to just 5, but focusing on the right variables, and this just kind of comes back to knowing your business. And again, so much focus can be put on growth that it's easy to forget that, again, what are you trying to do as a business? You're trying to make money. And so return on capital, and again, take the accounting for what it is, make your own adjustments. I mean, that's where you have to know the business. But it ultimately has to become a profitable investment at some point, and you have to have a return on your capital. I think a lot of businesses can really be understood. This framework that I kind of came away with from studying Berkshire Hathaway is sort of this two variable model, which is capital intensity and then operating margin. Basically describes a lot of businesses. How much capital is this business employing? What kind of opportunity, here comes to the growth part. What kind of opportunity do they have to employ more capital? And again, that might be in fixed assets. It might be an investment on the income statement that gets expensed, so it reduces earnings, but it's still an investment nonetheless. Is a competitor going to come in and change the dynamics that make this business require additional capital, or make it harder for them to invest capital? And then on the flip side, margins. What will margins do over time? Will competition diminish them? And big profit margins don't necessarily equate to a strong return on capital. One business within Berkshire Hathaway is a company called McLean. They're a distributor of groceries and alcoholic beverages and things like that. They survive on a net profit margin of 0.5%. Well, it's gotten to be a more difficult business, but when they bought the business, they were at a 1% margin. And even there you say, well, geez, that's terrible, right? Well, not if you're turning your capital over 15 times, right? So if you have a 1% margin, you turn capital over 15 times, you're making 15% on your capital. So margins aren't always the be all end all. Growth isn't the be all end all, but I spend an enormous amount of time when I look at a business or write up a business for my newsletter on trying to determine what are those real key variables in any given business. In the banking business, it's basically how much overhead does the business have and how much loan losses does this bank have over time. The beer industry I've studied recently, which basically, again, kind of comes down to volumes that they're putting through the system, their operating margin, and then how much capital do they require per hectoliter of that volume. I've actually made up my own variables over time. I looked at the waste management industry and I said, well, this is kind of crazy. They talk about yield, which is basically pricing, but nobody's talking about operating profit per ton moved. And so I said, well, I'm going to just create this own ratio of my own. I think it's well worth your time to think about what matters for a business and challenge yourself to come up with no more than 3. It's very easy to say, well, geez, let's look at all these different metrics, I don't know, annual recurring revenue, customer acquisition costs, all these, sort of exciting variables and growth. And they're not unimportant. It's just in the right context. But really, what are those key fundamental drivers that you can really pay attention to for this business will really take you a long way in becoming a better investor. And so all these lessons, I think that come from Berkshire Hathaway are 100% applicable to growth investing, even though I think they're two sides to the same coin.
Very good. Well, our founder, Simon Erickson, is going to be delighted with that comment because he forces us all to think about exactly that. Whenever we make a stock recommendation, can we think of the 3 metrics that matter? What are the things that we should be watching? Because you really want to simplify, your ability to monitor the company in the future. And if you can come back to those 1 or 2 things, remind yourself, okay, if it's Airbnb, are there average daily rates and the number of nights they've sold? Are those numbers improving in line with your investment thesis, for example? Something very specific that gets to the heart of what the business is actually doing.
Yeah, I mean, so many times. That's why I love going out to Berkshire Hathaway, the annual meeting. I've been out there 9 times, and Warren Buffett just has this wonderful way of simplifying things. And Airbnb, it's like, okay, they're finding people to stay in other folks' homes, which basically means they don't have to have this huge investment in fixed assets. And I mean, it's such a simple business at its core, right? But then you pack all these different metrics and things on top of it, and they ratios and this and that, and you really can get lost in all the data that's out there. And I think starting with that basic model and then building on that would help a lot of folks. And if you can't understand it, again, it might just be you, or it might just be something that you pass on, which value investors do as much as growth investors.
And maybe it's not you. Maybe there is something really fishy happening in the way the company's sort of positioning their financials, and they're trying to gloss over the truth. So another good reminder there of that previous comment. If you don't get it, probably it's not the right investment for you.
Yeah, and let's not forget, management teams are human just like we are, right? I mean, if there's that FOMO aspect there too, where especially if it's a nascent industry, that scale matters, and you have to get to that scale. Oh my gosh, I really need to grow this business, and that management teams are subject to those things just as much as you are. And again, I suspect that a lot of these fly-by-night investors aren't reading conference call transcripts, but don't be daunted by the 10K. Just read a couple of the sections. It doesn't have to be too complicated. Listen to what management's saying. I think couple of little things that, us value investors pride ourselves on would make you better growth investors too.
Absolutely. And, actually, I find it incredibly valuable listening to the leadership team. So I guess if you're listening to this podcast, you're clearly a fan of podcasts or YouTube. You can just go have a ferret around, a bit of a Google search. You can often find the CEO or the founder chatting, being interviewed. You can get a lot out of, the language they use, get a sense of their vision, their commitment to the business. Sometimes they'll go a little bit off script. And if their marketing or the legal person hasn't reined them in, you might learn something quite interesting about the future aspiration for the business.
And even this is just sort of a real tangent here, but even what drives them, right? I mean, these qualitative factors. I just started reading Isaacson's biography of Leonardo da Vinci, and he talks about how Leonardo's family were notaries, which, from what I understand, are basically lawyers of 500 years ago. And so he picked up, Leonardo, even though he didn't become a notary, picked up this penchant for recording everything. And so he created these wonderful notebooks, which have come down to us today. And so I bring that example up just to say, there may be something, maybe the CEO is talking about something in his past or how he views, I don't know, his favorite vacation spot or what he likes to do with his kids, or, I mean, it could be anything. And you say, well, geez, this is why they do this, right? I mean, just things, you just never know where things are going to come and click for you. It just, again, just sort of circles back to, okay, everything's interconnected and we can learn from everything. It's just fascinating.
Fantastic. Well, that's a great place to sort of wrap up the conversation. I think you've put it together really nicely there. And I suppose, you've left anybody who's a student of Berkshire or Warren or Charlie, you've left them this fantastic tome to go and dig into. If listeners of the podcast would like to read more of your work or find out more about you, where could they find you online?
Yeah, so I'm on Twitter. I've kind of shrunk my online presence a little bit over the last few months, but Twitter, BRK_student. I have a companion website for the book, brkbook.com, has a timeline. You can find all kinds of the old reports and things like that on that website. Watchlistinvesting.com is my newsletter. Where else? I'm on YouTube. Again, the Oracle's Classroom, Adam Mead. You'll find me. I tend to upload. My most recent project is going through the Berkshire Hathaway annual meetings, the video ones, and taking out clips that I think are very important and these sort of timeless lessons from Berkshire Hathaway. So that might be something of interest to your audience. But please, by all means, reach out. I love hearing from people. Love answering questions to the extent that I can and that I'm able, and just I usually learn something from everybody. So love to hear from you.
Fantastic. Well, thanks, Adam. Thanks for making the time to share those fantastic lessons with 7 Investing listeners. You've been listening to the 7 Investing podcast, where it's our goal to empower you to invest in your future. If you want to know more, swing by 7investing.com/subscribe, where we've got a great deal on your first month of membership and access to our deep repository of, I think, nearly 150 stock recommendations, deep dive videos, and regular company updates. And I will just say, in the last month, we launched something called the 7 Investing Strong Buy Portfolio. That's our 20 highest conviction stock ideas across that whole universe of stocks. So really, no better time to sign up and become a member and start getting involved in some of those community discussions at our Discord. Well, thanks for listening, and thanks again to our fantastic guest, Adam Mead. Thank you.
Thanks, Luke.